So we welcome you today. Certainly we're very privileged to have Drew Markson in the room, certainly participating in a webinar. And really today the focus is going to be around platinum options and how you can use the derivative platinums that we have already listed on the JSE to be able to build up a option strategy or structure. Drew has been in the commodity markets for many, many years. He's currently a commodity trader at HB Capital Limited. And certainly thanks very much, Drew, again for your time today.
Yeah, thank you for having me, Chris. Okay, everyone, welcome to today's webinar on JSE Platinum Options. I will start out by talking a bit about the fundamentals of the platinum market, and then I will talk about an option strategy that we can use which will limit our risk and enable us to profit from the platinum market. First, I'd like to talk about the investment thesis that I have for the platinum market, and it is basically a bullish investment thesis. And my investment thesis is very simple, and it's supply and demand. Basically, supply is going down and demand is going up. Let's talk first about the supply. Now, most of the gold that's been mined throughout the world, throughout history, is still available as above-ground supply, as above-ground stock. For platinum, this is not so. Most of the platinum mined throughout history has been consumed by either industrial or commercial interests via jewelry or various industrial demands, and by being literally burned up and consumed in the autocatalysts of various cars and trucks around the world. So, unlike gold, with respect to the above-ground historical supplies for platinum, there aren't many. They've been used up in these catalytic converters. They've been used up in chemical processing, and they've been largely used up and consumed in jewelry. It is estimated, however, that there is approximately 4 to 5 million ounces of above-ground supply in a marketplace where the annual supply and demand for the metal at large is 8 million ounces. So it's estimated that there are 4 to 5 million ounces of above-ground stock in a market that requires about 8 million to balance the supply and demand curves. However, half of this above-ground stock is held in various exchange-traded funds, including one listed here in South Africa. And this platinum would most likely not be released and available to the marketplace unless platinum prices moved substantially higher and there was profit-taking from the exchange-traded funds, or if platinum moved lower and there was loss liquidation from current levels. Such activity happened last year in the gold exchange-traded funds. Gold prices declined substantially last year, and there was a lot of liquidation of the gold stockpiles in exchange-traded funds, and it found its way out into the marketplace and apparently out to Asia. The rest of the above-ground stock is the result of stockpiling by producers and consumers, and to some extent by investors in the form of physical investment demand. Now, about 1 million ounces, about half of that stockpile, may have been drawn down as a result of recent strike actions. This leaves us with mining supply. Approximately 90% of the world's platinum supply comes from just 3 countries, South Africa, Russia, and Zimbabwe. South Africa is the largest producer, and it produces approximately 70% of the world supply. At current platinum prices and cost of production levels, about half of all South African mine shafts may actually be making a loss. It is therefore likely that the platinum mining companies themselves are not earning their cost of capital, and very soon they could become outright loss-making enterprises. The supply of South African platinum group metals has also been on declining for the past several years, and especially recently in light of all the strike action. Several industry players have been commenting and claiming that in order to maintain current output, the mining companies may have to make up to $8 billion, about 80 billion rand worth of sustaining and new capital expenditures over the next several years. There is just one problem. They don't have the funds and most likely cannot raise them from shareholders or bankers because they're not earning their cost of capital. It's very difficult to go to your shareholders or bankers and say, hey, I've got a great idea. I want to expand my business where we produce a product at the cost of production and sell it at the same price or lower. Next, I would like to talk about the problem of mining costs. According to the recent annual reports of the two largest platinum producers in South Africa, Anglo American Platinum and Impala Platinum, it costs them between approximately 15,500 to 17,000 Rand per ounce to produce an ounce of platinum. The current market price for platinum is right around these levels. In fact, earlier this morning, platinum futures on the JSE were trading at about 15,700 Rand per ounce. Two of the biggest costs involved in platinum mining are labor costs and electricity, power costs. Both of these costs will be going up substantially in the next few years. Recent negotiations involving labor and management seem to indicate that certain wage rates related to entry-level employees will rise approximately 50% over the next few years. Wage rates for those above entry level will also rise accordingly. Platinum mining is a power-intensive business. South Africa's government-run monopoly power supplier, Eskom, is mismanaged and unable to deliver on its political mandate to deliver affordable power to the people. Power demand is growing and supply is shrinking. Costs are increasing, and a combination of load shedding and roaming blackouts is becoming the inevitable legacy of this policy. Recent news reports indicate that the management of Eskom is aware of this failure, and so they have agreed to forego bonuses of about 10 million Rand. This may make for great public relations, as the public reaction to this failure seems to be muted so far. However, the 10 million Rand in supposed savings does little to correct an estimated 250 billion Rand funding gap, which faces the utility and, in fact, the nation and its treasury over the next few years. In fact, these so-called savings from reductions in bonuses to Eskom management amounts to less than 0.0005 of 1% of the estimated funding gap. Even worse than the mines they supply, Eskom is also not earning its cost of capital. This will have to be made up by substantially higher electricity prices in the coming years. My conclusions on supply are that they are limited, that there are limited historic above-ground supply of platinum. There is an apparent demand over supply imbalance of perhaps several hundred thousand to 1 million ounces per year. It looks like it will be that way for this year and for the near future, quite possibly longer. Recently, production and supplies have been declining. Wages are set to rise rapidly. Electricity prices are set to rise rapidly, again after a recent 3 or 4 year period of rapidly escalating prices. And the supply of that electricity is becoming increasingly tenuous. An increase in capital expenditure is required at the mines, and it may not be achieved due to the difficulty of raising the funds. The obvious conclusion is that supply will be constricted, and this will be especially true if prices decline. Next, I'd like to talk about platinum demand. The utility value for platinum group metals in society is high, and for the moment, there are no real substitutes. Basically, it comes down to a choice: platinum or smog. That is the trade-off for now until a substitute becomes available. There are, in fact, political movements going on in the United States and in Europe, Japan, and in China, which are resulting in more laws and environmental standards designed to improve the air quality, but not to conserve the supply of platinum group metals. In places like China, and I guess you could also say India, they currently use less than 10% of the platinum group metals per vehicle than what is used in the United States, for example. As a result, their air quality is legendary for being deplorable. However, this is in the process of changing, and with it, increased demand for platinum group metals. As we speak today, Euro 6 emissions legislation may result in about a 25 to 50% increase in European platinum demand in the European heavy-duty diesel truck segment. Also recently, the Chinese government has identified cardiopulmonary illnesses as a consequence of poor air quality as one of the leading causes of death in China. They have proposed air quality standards which will quadruple platinum and palladium loadings on trucks and on cars that are either produced or imported into the Chinese market. In the future, if not now at this very moment, China will be or is the largest car and truck market in the world. One final point I would like to make concerning demand is as follows. There are about $200 to $300, or perhaps 2,000 to 3,000 Rand of platinum group metals used in a typical car. The median price for a new car in the United States is approximately $25,000, and in South Africa, plus minus 250,000 Rand. Well, if the platinum and palladium prices were to double from current levels, the impact on your new car prices in the United States would be $200 to $300, and in South Africa, perhaps 2,000 to 3,000 Rand, probably less since South Africa is using less platinum group metals in their vehicles, especially their trucks. The sticker price change is far too small to make an impact on vehicle demand in either country. So basically, if platinum group metals prices doubled from their current levels, the response to the demand for autos and thus for platinum group metals would be relatively inelastic. It would not make an iota of difference to vehicle demand and hence platinum group metal demand. In conclusion, the demand factors indicate, to me at least, that the demand for platinum will increase. As a result of the increase in demand, in addition to the new supply factors discussed earlier, platinum prices are as close as one can get to a one-way bet up. Next up, I would like to discuss a way to take advantage of these trends. We will use options traded on the JSE to both limit our risk and to make our profits. JSE Platinum Options. Options contracts can offer a virtually unlimited array of trading opportunities. One of the chief advantages of options is the ability to tailor your positions to meet your specific risk parameters and market outlook. For the option buyer, an option is a contract which conveys the right but not the obligation to buy or sell something at a predetermined price at any time within a specific time frame. I will get to these specifics more in a few moments. For the option seller, an option is a contract which obligates the seller of the option contract to buy or sell the commodity stated in that option contract at a certain price by a certain date if the option contract is exercised. There are two types of option contracts traded on the JSE, call options and put options. I will ignore defining call options for now, since when I talk about examples later on in this course, I'll be talking about put options. But I have left the call option definition on the screen and in the notes. And if you require a copy of the notes, you can email me at the email address I provide at the end of this seminar. So since we're not covering call options, I will go on to put options, which is something that we will be using a lot today. A put option gives the option buyer the right to sell the underlying commodity. Now, sometimes that's confusing to people, but basically, if you buy a put option, you have the right to sell a commodity. If you buy a put option, you are either bearish and think prices of that commodity will decline, or you are looking to hedge the downside risk that you might have in that commodity because you own the commodity or you own futures contracts or exchange-traded funds on that commodity. Now, the option seller, so the seller of the put option, that person is obligated to buy the underlying commodity. So it's very confusing. If you sell a put, you're buying the commodity, and if you buy a put, you're selling the commodity. But anyway, that's how put options do in fact work. So the option seller, person who sells a put option, they are obligated to buy the underlying commodity. In the case of JSE options on precious metal futures, the underlying commodity will be a futures contract on precious metals, or perhaps a futures contract on shares in an exchange-traded fund, an ETF, such as the New Gold Platinum Trust, the NGPLT. It trades as a share on the JSE, and of course they have futures contracts and option contracts that trade on the financial derivatives division of the JSE. The price for all of this flexibility is the premium. It is in fact the price that's paid by the buyer of the option and received by the seller of the option. The amount of this premium depends on market conditions, such as volatility, how volatile a market is. Time to expiration. The more time to expiration, more expensive the option. Less time to expiration, less expensive the option. With volatility, similar result. The more volatile a market, more expensive the option contracts. The lower the volatility of a marketplace, the cheaper. Market direction also can affect these premium prices. The relationship of the option's strike price compared to its market price also can affect the price of these options, and I will cover all of this a bit later, and also the supply and demand for options in general. It's basic economics 101. If everyone is trying to buy options and no one is trying to sell them, then they will be more expensive than if everyone was trying to sell options and no one was trying to buy them. Now, regardless of how much the market fluctuates, the most an option buyer can lose is the premium or the price that he or she pays for the options. Because of this limited and known risk, people who buy options are not faced with margin calls above what they pay for the option. However, option sellers face similar risks as futures traders, and they must post additional margin if the market moves away from them. Okay, next I would like to talk about a platinum option strategy on the JSE. How would you like to collect option premium income regardless of most of the seesaws in prices in the platinum marketplace? What follows is a complementary trading strategy involving JSE Platinum put options, and it's designed for collecting short-term option premium income with limited risk. First, I need to get a little disclaimer out of the way. The following will be for information and education purposes only. It should not be construed as investment advice. This is mainly a webinar designed for education and information. Futures and options are actually risky investments, and they can result in substantial losses if they are not handled correctly. Please, you will need to consult with your own financial advisors in order to determine if trading futures and options strategies are appropriate for your account and risk. I wish to assume no responsibility for your particular trading results, and this is not a solicitation by me or the JSE or anyone involved in today's webinar to buy or sell anything. Okay, I'd like to move on, now that we've gotten the legalese out of the way, to the example of how we can capitalize on our bullish view. Let us assume that we have 50,000 Rand of risk capital, and we are prepared to risk that amount in order to try and double our funds over approximately the next 3 years, while at the same time guaranteeing that we limit our risk to the 50,000 Rand of risk capital. Well, the following JSE Platinum put option example may be appropriate. I've put into my option model the following information based on where the Platinum futures are trading on the JSE. I have the September 2014 Platinum futures currently trading at 15,700 Rand per ounce. Each future or option contract represents 10 ounces of platinum. In our example, we are going to do the following option spread strategy. Okay, and I'm just going to highlight it. We are going to sell 10 of the September 14,500 puts for 80 Rand per ounce. 10 contracts represents 100 ounces, or 8,000 Rand. So basically, the first leg of our trade is to sell the September 14,500 puts. I see the option model indicates we can get approximately 80 Rand per ounce for that trade, or 8,000 Rand. Next, we will buy 10 contracts of the September 14,000 puts for 30 Rand per ounce, or 3,000 Rand for the trade. The net amount of premium we take in by selling the September 14,500 puts and buying the September 14,000 puts is a 50 Rand per ounce credit, or 5,000 Rand in total. So we're taking in a 50 Rand credit, or 5,000 Rand in total. I'm just going to clear up my screen. Okay. What I'd like to do now is describe the position, including a unique stop-loss feature that options allow us to have. So we think platinum prices are going higher. In order to take advantage of that, we are going to sell 10 contracts of the September 14,500 put options for 80 Rand per ounce, or 8,000 Rand. Now that will potentially obligate us to buy platinum if it goes lower than 14,500 Rand. Okay, we're happy to do that because we think platinum prices, which are currently trading at 15,700, will stay at those levels or go higher, in fact. The second leg of our strategy protects us against losses and makes sure that we never lose more than the 50,000 Rand of risk capital. By buying the September 14,000 puts for 30 Rand per ounce, or 3,000 Rand, what we have is the right to sell platinum at 14,000 or lower if, for example, we were forced to buy the 10 contracts at 14,500 because, for example, perhaps the market plunged. And if it continued to go lower, we can stop ourselves out, so to speak, by using our September 14,000 puts to sell that platinum. The most we would lose on the trade would be 500 Rand per ounce, 50,000 Rand, less the 5,000 Rand that we took in for the trade. I will cover this in more depth, all of the mathematics on how options work, next by what I call the three wise men. Whenever I do a trade, I want to know what the three wise men tell me so that I really understand intricately how this complex option strategy performs. The three wise men are very simple. One is called max gain, the other is called max loss, and the final one is called break even. And now I'll go over those features to determine our risk and reward characteristics of the trade. So our maximum gain occurs as long as the platinum market is trading at 14,500 Rand or higher, I mean up to infinity. So as long as platinum is trading at 14,500 or higher, we will make the 50 Rand per ounce that we took in as a credit from the trade, netting us 5,000 Rand in this example. Okay, so we'll go back to the trade for a minute. So as long as platinum stays higher than 14,500, we will keep this 50 Rand per ounce credit. This 5,000 Rand, it's ours to keep. And it's a 10% return on our capital for about 3 months' work, as you'll see. And what's nice about that is you don't necessarily have to watch platinum on a day-to-day basis. I mean, platinum would have to drop from 15,700 to 14,500 before we even get worried about any type of potential losses. That would be about an 8% decline from current levels. So we have quite a bit of protection in this example. I'm just going to go back to normal drawing. Okay, so our maximum gain of 14 occurs when the price is at 14,500 or higher and we make our 5,000 Rand. Okay, we are not going to stop there. We still have a good strategy. Our follow-up strategy is to look for a similar position to execute, but in the December 2014 JSE Platinum options. We will do that when these September options reach their expiration date. However, when this happens, we're going to need to analyze where the market is trading. We're going to need to find a similarly situated option structure, but it will be in the December contract. We will then try to execute these options with the similar criterion that we just did with the September series, but we would do it in December. Now, if it's not possible, then, if it is possible, we will execute the strategy. If it's not possible, because perhaps market conditions have changed, maybe they've changed substantially and adversely against us, maybe the technical or the fundamental information of the market has deteriorated, or perhaps some news has come out that's changed our investment thesis. If that happens, well, we will simply take our 5,000 Rand profit from the current strategy and just move on to something else that doesn't involve platinum or platinum options. And we will have made 5,000 Rand on a 50,000 Rand investment in 3 months. The second wise man we'll cover is break even. This occurs at the expiration at exactly 14,450 Rand. Why does break even occur at that level? Because at this level, we would be obligated to buy our 10 contracts or 100 ounces of September platinum at the 14,500 Rand strike price. Remember, we sold those options. I'm going to go back to it. Remember, we've sold 10 contracts, 100 ounces worth of the 14,500 puts, okay? Well, the market currently is at 14,450. Let's see what happens. I'm just going to erase this information. Okay. Well, if the market was at 14,450 and we liquidated our position, we would actually incur a 50 Rand loss, because if we bought at 14,500, which is where we were obligated to buy based on the options, and if we sold it immediately in the marketplace for 14,450, we would lose 50 Rand per ounce, or 5,000 Rand. However, this 5,000 Rand loss, this 50 Rand per ounce loss, is offset by the option premium income that we took in when we initiated our option strategy position. Remember, when we put on these trades, we earned 50 Rand per ounce, 5,000 Rand. So hence, we will break even on the trade. Our follow-up strategy is to do a similar strategy that we had just done in the September options, but in the December 2014 option series. Basically, we're going to do more of the same. We will need to reanalyze the market. We'll need to make a determination if it's still appropriate. And if it is appropriate, the technical situations, the fundamentals of the markets, the news is still favorable for us, we'll execute the similar strategy. If it's not appropriate, if things have changed technically or fundamentally or news-wise, then we will simply move on to something else that does not involve platinum or platinum options, having made or lost nothing but spent about 3 months of time. Finally, the third wise man is max loss, and it's very crucial to understand maximum loss, because this helps us limit our losses to the 50,000 Rand or less of risk capital that we have. Well, our maximum loss occurs at the expiration of the September options if the platinum market is trading at 14,000 or lower, because at this level we will be obligated to buy 10 contracts at 14,500. Remember, we sold the 14,500 puts. Well, if the market is 14,000 or lower, someone is going to definitely sell us platinum at 14,500. We have to buy that from them. However, once the market trades 14,000 or lower, we had bought the 14,000 put options, and we will then have the right to sell those 10 contracts, those 100 ounces, at 14,000 back to the market. That is our automatic stop loss feature that I have been talking about. This results in us losing 50,000 Rand from buying and selling platinum futures derived from our option position. However, we still have the 50 Rand per ounce, or the 5,000 Rand credit we took in initially. And this will lead us with a total loss of about 45,000 Rand, or almost all of our capital. We've lost 45,000 Rand out of 50,000 Rand of risk capital. Our follow-up strategy is to most likely admit that we are wrong, accept our budgeted losses of our risk amount, and move on to something else that probably doesn't involve platinum. Okay. One of the great things about options is they are a much more forgiving parent than trading futures or trading shares. They usually give you chances to come back. They usually give you a second chance. Next, I'd like to cover how options help in regards to how to make a bad loss better and give you a second chance. So in the next example, we might not have a maximum loss, but we will have a bad one. And I will show you how to stay in the game and potentially turn that losing situation around into a profitable one. It's a very crucial concept we need to learn. I see it in, unfortunately, one of the analogies I'll need to make is casinos. If a punter goes into a casino and beats a casino at a game that the casino has a positive expected outcome in, such as blackjack, the casino doesn't close down for the evening and stop. No, they reload and try again, because they know over the long run they're going to cash in on the positive expected drift in their position. I think a similar situation could be in the platinum options market. I'll like to talk about that next. Okay. As noted so far, under all of the above trading scenarios, except for the maximum loss, we will most likely be repeating a similar trade after an option expiration cycle. We will do it in the next option series. So just like a washing machine cycle, we're going to take something that works well in achieving our objectives in a washing machine, cleaning your clothes, in trading, making profits, And we will wash, rinse, and repeat, just like the washing machine. We will continue to do this until we double our money or we lose our initial risk capital, or the situation in the marketplace changes due to adverse markets or a change in the news, technical, or fundamental information. I mean, you look at when the trade works, it makes a 5,000 Rand return on a 50,000 Rand investment, or 10%. All we need is to do that 9 more times, approximately 2.5 to 3 years, to double our money. Okay. So let us assume that we have on the same trade on as previously discussed, the September option structure, where we sold the 14,500 puts and bought the 14,000 puts for a 50 Rand credit or a 5,000 Rand credit. And let us further assume that we are about to incur a bad loss. But the news and the technicals and the fundamentals related to the platinum marketplace are still reasonably favorable. We still think we have an edge. How do we handle this adversity and get a second chance to try to double our money by the previously mentioned and so-called wash, rinse, and repeat cycle? And we've discussed the casinos, and you also see it in rugby too. When a rugby player gets hurt, I was watching last week down in Durban, South Africa play Wales, and when a rugby player gets hurt, they don't go off the field. They dust themselves off and get back in the game and try to win. This is the same thing we need to do in trading. So we have on the same trade as previously. Let us assume that we're faced with the following situation and following prices. So we have September option expiry, and September platinum futures, I see they're trading at 14,300, and the December platinum futures are trading slightly higher at 14,500 due to the cost of carrying platinum for 90 days more. So you'll frequently see that in the platinum market, that the further out contracts trade at a higher premium than the spot contracts or the most recent contracts. You see it in the exchange traded fund as well if you trade futures on the ETF. And that is basically the cost of carrying the platinum or the exchange traded fund. So we have these prices. Well, based on that, the September 14,500 put option would be worth 200 Rand per ounce. The 14,000 put options would expire worthless. And when I look over into December options and see a similar option structure, I see that the December 14,500 puts are trading for 420 Rand, and the 14,000 puts are trading for 215 Rand. So what can we do with this basic price matrix? Our defensive strategy, our follow-up strategy, consists of us liquidating our September option strategy. And when I look in the option model, I can see we can buy back our losing short position in the September 14,500 put options for 200 Rand per ounce. We must remember to credit ourselves for the 50 Rand per ounce of option premium which we took in at our initial entry. And we'll see that we'll let the September 14,000 puts expire worthless. This results in a 150 Rand per ounce loss. We took in a 50 Rand credit. We lost 200 Rand by buying back the 14,500 puts. That is a 150 Rand loss, or 15,000 Rand loss on our 100 ounce position. We'll need to keep this in mind, unfortunately, and we will need to remember and carry forward this legacy loss in our future analysis until it's completely offset by future profits or it's fully accounted for. So first step, liquidate our losing September trade. We can see we have not lost our 50,000 yet. We still have it in place. And we will reestablish our position in the December option series in a similar structure by selling the 10 contracts of the December 14,500 puts, and the option model indicates that we can get about 420 Rand per ounce for this. And we will buy, to give ourselves stop loss insurance and protection, we will buy the December 14,000 puts for 215 Rand per ounce. We can take in a lot more of a credit because the market, unlike when we initially started, is a much lower level. The market now is around between 14,300 to 14,500 Rand per ounce. When we started, it was around 15,700. We will take that large credit of 205 Rands per ounce, or 20,500 Rand. Thank you very much. And then our next step is to analyze our risk and reward potential via the three wise men. So let us just remember, we've liquidated our legacy September position for a 15,000 Rand loss, and we've established a new position in the December contracts, which will make us a 20,500 Rand credit, hopefully. Now, it may not work out that way, but we will look at the three wise men and see what could happen to us. All right. Now, with respect to the three wise men, we must keep in mind that we have to adjust all of our analysis by the 150 Rand per ounce, or the 15,000 Rand that we lost on our initial September position. Let's look at our maximum gain. Our maximum gain occurs from 14,500 Rand up to, theoretically, infinity, and it results in us making the 20,500 Rand credit that we took in from this new option spread, less the 15,000 Rand legacy loss that we incurred in our initial position, for a total gain of 5,500 Rand on the total position. I'll go over the calculation right now. So remember, we have a 15,000 Rand legacy loss from our previous option position. Remember, we did an option structure where we sold the 14,500 puts in December and bought the 14,000 puts in December for a 205 Rand credit, or 20,500 Rand credit on the total position. So let's go through the math and see how I got this max gain scenario. I'll do that right now. Okay, if the market prices at 14,500 Rand or higher, well, the 10 contracts that we sold at 14,500 on the puts will expire worthless. The same will happen with the 14,000 puts that we bought. I mean, we don't want to exercise 14,000 puts and sell at 14,000 if the market's trading higher than 14,000. They will expire worthless. When both options expire worthless, the credit of 205 Rand an ounce, or 20,500, is ours to keep. Our follow-up strategy is to look for a similar position to execute then in the March 2015 JSE Platinum options, when these December options reach their expiration date. We will, of course, need to analyze where the market's trading and find similarly situated options, but they will be in the March 2015 contract, and we'll try to execute them with similar criterion as we did in the December series. If this is possible, we'll execute the additional strategy. If it's not possible because the market conditions changed adversely, or technicals or fundamentals have gone against us, then we will take our profits from this current strategy and move on to something else, having made a total profit of about 5,500 Rand on a 50,000 Rand investment for about 6 months worth of work. Not too bad. Our break-even for this trade occurs at exactly 14,445 Rand. Why? Well, because we are obligated to buy 10 December platinum futures at 14,500 Rand per ounce, because remember, we've sold at the December 14,500 put. Someone who sells a put is obligated to buy if the market is below the strike price level. In this example, at 1445, the market is 55 Rand below the strike level. If we bought those futures at 14,500 and liquidated them immediately at 14,445, we'll suffer a 55 Rand per ounce loss, or a 5,500 Rand loss on the total position. However, it'll be completely offset by the 205 Rand per ounce, or the 20,500 Rand of option premium we took in when we initiated our December option strategy. However, we also need to account for the 150 Rand per ounce, or the 15,000 Rand loss from our legacy September 2014 option position. So we add up all of the numbers, the minus 5,500 Rand from buying and selling futures related to our December position, plus the 20,500 Rand credit we took in when we initiated the trade, and the 15,000 Rand legacy loss, and that gives us a break-even level of 0. Hence, we break even on the trade. Our follow-up strategy is to do more of what's working, a similar strategy, but in the March 2015 option series. We'll need to reanalyze all of the market information and make a determination if it is still appropriate, and then execute a similar strategy. If it is not appropriate, we will move on to something else, having made or lost nothing over a 6-month time period. And finally, in our worst case scenario, the maximum loss from this position occurs at 14,000 or lower at the December option expiry, because at this level we're going to be obligated to buy 10 contracts of the December 2014 Platinum futures at 14,500. Remember, we sold those options. We're obligated then to buy if the market is lower than 14,500. Well, once the market trades 14,000 or lower, we bought the 14,000 puts. That will give us the right to sell our 10 contracts that we had bought at 14,500. Unfortunately, at 14,000 back to the market, that's our automatic stop loss feature, and makes sure that we do not lose more than 50,000 Rand of our capital from buying and selling platinum derived from our December option position. And this results basically in a 50,000 Rand loss, less the 20,500 Rand that we took in from our previous position. That's a loss of 29,500. However, we also must not forget the loss on our initial September 2014 option position, and thus we must add that in the mix for a total of 50,000 Rand loss from buying and selling futures related to our December options, plus the 20,500 Rand we took in from initiating our December option position, less our 15,000 Rand of legacy cost from our September option position, and we have a 44,500 Rand loss. Almost all of our 50,000 Rand risk capital has been lost. Our follow-up strategy is most likely to admit we are wrong. In fact, we've been wrong twice. We need to accept our budgeted losses of our risk amount and move on to something else, something that probably does not involve platinum futures and options. That wraps up the webinar today. In conclusion, I hope you found the material in today's presentation informative. I realize I covered a lot of material in a short period of time. If you have further questions, then please contact me at the email address located at the bottom of your screen, and that is drew.markson, M-A-R-K-S-O-N, @gmail.com. Also, if you want a copy of today's presentation, feel free to email me, and I will forward you a copy of this presentation for you to look at yourself. I wish you the best of luck in your future research and trading, and I hope today's webinar helped you in that regard. Thank you very much.